You know, we're moving way beyond just simple digital transactions now. We're stepping into a whole new paradigm, shifting from a world that's all about process to a world that's all about intelligence.
This quote from Jim Roche, I think, just perfectly captures that fundamental change happening right now. Banks are evolving from just being digital first to being intelligence first. Okay, so let's really dive into what that means.
All right, so in this explainer, we'll first cover this revolutionary shift happening in banking. Then we'll trace AI's journey through the decades, understand why banks are investing so heavily, break down the core technologies, look at the data that fuels it all, and finally, see what it takes to build a modern AI bank.
So, what does it even mean to be intelligence first? Well, it's about embedding AI into the very core of banking. We're talking about creating a system of real-time perception, automated decision-making, and then execution. It's moving from just processing transactions to actually predicting your needs.
Right. And this transformation, it didn't just happen overnight. It's really been a long journey. Let's take a quick look at the key milestones.
As you can see here, AI in finance started out with these really rigid, rule-based systems, simple if-then logic. But a major catalyst for change was the 2008 financial crisis. That really forced institutions to adopt much more sophisticated, data-driven models to try and decipher these complex risks that the older systems just couldn't predict.
Okay, so what's really interesting here is why this adoption accelerated so much. And it really boils down to three core economic drivers.
Yeah, the business case it's incredibly compelling. You've got massive cost savings through automation, incredible speed that totally enhances the customer experience, and of course, greater accuracy that seriously reduces risk and financial crime.
And you can see it right here. The industry fully expects these benefits to hit the bottom line. The vast majority are anticipating pretty significant profit boosts, all driven by AI.
Okay, so when we say AI, what are we actually talking about? It's really a whole suite of technologies. It's super important to understand the different tools in the toolkit.
A great way to think about this is that RPA provides the hands to perform all those repetitive tasks, while AI, that's the brain. It handles the complex reasoning and decision-making. So let's break that brain down a little further.
First up is machine learning. This is really the workhorse of financial AI. It's all about one thing, learning from past data to predict future outcomes. Deep learning then takes this a step further. It uses these really complex structures, inspired by the human brain actually, to find incredibly subtle patterns. This makes it super powerful for things like advanced fraud detection. And this is a great example of the power of natural language processing, which is what gives machines the ability to understand our language. I mean, look at JP Morgan's Coin platform. It's used NLP to analyze 12,000 legal agreements in just seconds. That's a task that would have taken lawyers something like 360,000 hours to do. Just incredible.
So here's the crucial point. None of these powerful tools work without their fuel, and that's data. Seriously, the quality and the diversity of data is the single most important factor for success.
Right, and banks combine all these different types of data, from your everyday transactions to unstructured stuff like contracts, to build a full 360-degree view. And this is what allows the AI models to make these highly accurate, context-aware decisions. Okay, so how do banks put all this together? Because it's not just about plugging in one tool, it's about building a whole new architectural foundation. And really, the end goal here is to create a system where AI doesn't just give you suggestions. The goal is for it to actually carry out complex operations all on its own, but with safety and accountability built in right from the start.
And building this requires a pretty sophisticated tech stack. You have things like API gateways and microservices that allow these new AI tools to work with older core banking systems. And then you have things like explainability layers, which make sure that regulators and customers can actually trust the automated decisions being made.
All right, let's wrap this up. What are the key takeaways from all of this?
So, a few crucial points to remember. First, this is a mature field, not some new fad. Second, the adoption is fueled by a really powerful business case, cutting costs, boosting speed, improving accuracy. Third, AI isn't one thing, it's a whole toolkit. And finally, and maybe most importantly, data is the foundation. Without good data, none of this works.
And this all leaves us with a final, really important thought to consider.
As these intelligent systems take on more and more responsibility for critical financial decisions, it forces us to ask some new questions, right? Questions about oversight, accountability, and what the future role of human judgment in banking even looks like. Who is ultimately in control?
No, that's not science fiction. It's a constant, relentless cat-and-mouse game. On one side, you've got financial institutions trying to protect your money, and on the other, fraudsters who are getting smarter, faster, and way more creative every single day. The battlefield is completely digital, and the front lines, well, they're everywhere.
So what exactly are we up against? I mean, the modern fraudster's toolkit is shockingly diverse. You've got the classics, of course, like phishing and vishing scams, but now we're seeing criminals who physically tamper with merchant QR codes. There are fake collect requests, sneaky subscription frauds, and even SIM swap attacks to literally hijack your phone number. And maybe the scariest of all, entirely synthetic identities, built from scratch just to commit fraud. For years, we relied on a pretty specific kind of defense to fight off these threats. But as the attacks got more sophisticated, that old fortress really started to show its cracks. The old rules that once kept us safe, they're just not cutting it anymore. See, the old way of doing things was based on this really simple idea. Just create a list of rules. You know, a rule might be, hey, if a transaction is over $1,000 and it's from a brand new location, flag it. It's a very rigid black and white system. If a transaction breaks a rule, it gets blocked. If it doesn't, it goes through. Simple, right? But also deeply flawed. And this slide just lays the performance gap bare. Let's compare the old guard to the new. For detection accuracy, traditional systems maybe catch 60 to 80% of fraud. AI systems, they're hitting 85 to 95%, even with totally new scams. And adaptability? The old way is reactive. You have to manually update it. AI learns on its own, continuously. And response time? We're talking about hours or even days versus real time, in milliseconds. But the most important number here, the one that really hurts businesses, it's that false positive rate. Right. Traditional systems have a false positive rate as high as 20 to 30%. Think about what that means. Up to 3 out of every 10 transactions that get flagged are actually perfectly legitimate. This isn't just an inconvenience, it's what the industry calls a customer insult. You're blocking a real customer's valid purchase, and that completely damages trust, and you lose business. And this quote from Javelin Strategy and Research, it just drives the point home. The value of these false declines, the money lost from insulting your customers, is more than 13 times the amount lost to actual fraud. So the very solution that was designed to save money was actually costing businesses way, way more. It was clear a new approach was desperately needed. And that new approach came in the form of what you can think of as an AI detective. So instead of a security guard with a fixed checklist, imagine a brilliant investigator that can actually think, learn, and adapt on the fly. This is the absolute fundamental difference. AI isn't stuck with a pre-written rulebook. It sifts through massive amounts of data to understand what normal looks like for you. It learns your spending patterns, it adapts when they change, and because of that, it can predict if a new transaction is genuinely yours or if it's a threat. So this AI detective has a really sophisticated toolkit. First up is supervised learning. Think of this like studying with flashcards. It learns from past examples, transactions that are already labeled fraud or not fraud. Then you've got unsupervised learning, which doesn't need any labels. It just looks through all the data to find weird outliers that don't fit in, which is perfect for spotting brand new fraud tactics. And finally, there's deep learning, which uses these super advanced models to analyze not just single transactions, but the entire web of relationships connecting them. This chart gives us a fantastic visual of the performance difference. See that little sheep huddled in the middle? That's your traditional system. The bigger shapes, stretching all the way to the edges, that's AI and machine learning. On every single metric, from accuracy to speed to adaptability, the new methods just blow the old ones out of the water. It's a total game changer. And the speed is it's staggering. When you tap your card to pay for coffee, an AI model has to analyze hundreds of data points and give a risk score in under 100 milliseconds. That is literally less time than it takes you to blink. And some systems, like Visa's, can do it in about 1 millisecond. That real-time power is what lets them stop fraud before the money is even out the door. Okay, so the theory is one thing, but how does this AI detective actually work out there in the real world?
Let's take a look at some case studies from the biggest names in finance. But before we jump into those cases, we need to understand a key piece of tech that they all use: graph neural networks, or GNNs. So unlike models that just look at transactions one by one, GNNs are designed to see the connections, the relationships between different accounts, devices, and locations. And that is how they uncover organized crime rings. Think of it this way. A traditional system sees a single dot on a map. A GNN sees the entire flight path. It sees the network of airports that dot is connected to, and it sees all the other planes that are on the same route. It sees the bigger picture. And in fraud, the bigger picture is almost always where the crime is hiding. PayPal was a huge pioneer in this area. They use these things called graph databases to map out all those connections. So for example, if dozens of accounts are suddenly registered to the same little two-bedroom apartment, or they all share the same credit card number, they show up as a really dense cluster in the graph. That immediately flags a potential fraud ring that would be totally invisible to an old rule-based system looking at each account by itself. Now, Visa takes a slightly different approach, but it's just as powerful. Theirs is all about speed and scale. Their advanced authorization system crunches over 500 different variables for every single transaction that goes through their network. It's looking at your location, the merchant, the time of day, your normal spending habits, all to build a behavioral profile and make a risk decision in, yes, about 1 millisecond. MasterCard actually combines a few AI strategies. Their decision intelligence tool gives banks a real-time risk score. But what's really groundbreaking is how they use generative AI. It can analyze those tiny little test charges that fraudsters use, and from that, predict which cards are at risk before the major fraud even happens. That is a huge shift from just reacting to a problem to proactively predicting it. But this is a technological arms race. Just as our defenses get smarter, so do the fraudsters. And now they're beginning to turn our own weapon, AI, against us. And that's opening up a brand new and pretty dangerous frontier. The next major threat that's already on the horizon is deepfakes. We're talking about AI-generated audio or video clips that can create incredibly realistic impersonations. These aren't just for movie special effects anymore. They're becoming a powerful and terrifying tool for financial crime. What is so terrifying is just how accessible this technology has become. With only 20 seconds of your voice, maybe from a social media post, a fraudster can clone it. With free software, they can create a pretty convincing video deepfake in under an hour. And the impact is already happening. They're using these tools to impersonate executives, authorize huge wire transfers, and get past identity verification systems. And the potential financial damage here is just massive. Projections estimate that by 2027, fraud that's enabled by generative AI could cost the financial sector $40 billion. And that's not a one-time cost, that's every single year. Which, of course, brings us to our final question. We are in a perpetual race between creation and counter-creation. As criminals find new ways to weaponize AI, the AI detectives defending our accounts have to learn and evolve even faster. The invisible battle continues, and the question of whether our digital defenses can keep pace, well, that remains a critical one for all of us. Decades, getting a loan was all about that one simple report card from the credit bureau, right? But things are changing fast. Now, AI is looking at a much, much bigger picture. And believe it or not, a lot of that picture starts with the data that's sitting right in your pocket. Okay, so let's really break this down, the old way versus the new way. On one hand, you have traditional scoring. It's slow, it's kind of clunky, and it only looks at a very narrow slice of your financial life. The biggest problem? It leaves millions of perfectly creditworthy people out in the cold, just because they don't have a long credit history. But then you've got AI scoring. It's lightning fast, it's dynamic, and it can finally see those people who were basically invisible before. And this is the real game changer right here. It's not just about looking in the rearview mirror at your past payment history. Instead, AI models are analyzing this huge, rich set of inputs to get a sense of the full financial picture. The industry has a name for this. They call it alternative data. So what is this alternative data? Well, it's pretty much everything but your old school credit report. We're talking about how consistently you pay your rent or your utility bills, your cash flow. Even things like your job stability and your digital footprint can play a part. The whole idea is to create this really detailed, up-to-the-minute snapshot of who you are financially. It's a lifesaver for people with what they call thin credit files. Okay, so what's the magic behind the curtain? What's actually crunching all this data? Well, it's a whole suite of really sophisticated machine learning models. You'll see some fancy names on screen here, things like gradient boosting or deep neural networks. But listen, you don't need to be a data scientist to get the main point. Just think of them as incredibly powerful pattern finders. They can spot connections and predict risk with a level of accuracy that old-school formulas just, well, they can't even come close. So when you put all this tech together, what do you get? You get a totally new way of doing things. The whole loan application process gets automated. You just submit your stuff online, the AI does its thing in real time, and boom, you can get a decision in minutes. I mean, we're talking minutes, not days or weeks. It's a whole new world. And we're not just talking about a little speed bump here. This is a massive acceleration. The data shows that AI can speed up the entire credit scoring process by as much as 70%. That is a huge, huge leap in efficiency, both for the person applying and for the lender. And check this out. This is where it all pays off. It's a win-win. For the lenders, they see default rates go down by as much as 30%. That's huge. But for borrowers, and this is the really exciting part, approval rates can jump by 25%. That means we're opening the door to credit for so many people who were unfairly locked out of the system before. But it's not all that simple. There's a serious catch. If you train an AI on our financial history, what do you think it's going to learn? Well, it learns our past biases too. It can end up just baking in and even amplifying historical patterns of discrimination, like redlining, where whole communities were denied loans for decades. And the way this bias sneaks in is often really subtle. It happens through something called proxy variables. Now, what's a proxy? It's basically a piece of data that looks totally neutral on the surface, but in reality, it's a stand-in for something sensitive, like a person's race or gender. Let me give you some real-world examples. Your zip code, for instance. Because of decades of housing segregation, a zip code can be a very strong indicator of race. Or think about the types of stores you shop at, or even your level of education. Any of these could act as a proxy. So even if you carefully remove race from the data, the AI can still figure it out and end up discriminating. And this all feeds into what's known as the black box problem. These AI models can be so complex that even their creators don't always understand exactly why they make a certain decision. So if you get denied a loan, how can you know if it was fair? How can you challenge it? And how can regulators possibly enforce anti-discrimination laws if they can't see the logic behind the decision? It's a huge issue. So what's the answer? How do we build a fairer system? Well, there's no silver bullet. It takes a really deliberate, multi-pronged attack. You have to start with the data itself, make sure it actually represents everyone. Then you have to build fairness right into the code, into the algorithms themselves. And it doesn't stop there. You have to constantly audit these models to make sure they're not slowly drifting back toward biased outcomes. And the good news is a lot of brilliant people are working on this. Technologists are developing some really powerful tools to fight bias head-on. One of my favorites is called adversarial debiasing. It's so clever, you basically train a second AI whose only job is to try and find bias in the first AI. It's like having an internal auditor that forces the main model to get fairer and fairer over time. And this isn't just stuff happening in a lab, This is out in the real world, right now. You've got companies like Upstart that are using over 1,600 data points to approve more people for loans. Then you have companies like Tala, who are using mobile phone data to give credit to millions of people in emerging markets who never had access before. This really shows that when it's done right, this technology can be an incredible engine for financial inclusion. So where does that leave us? We're left with this big, important question. There's no doubt AI can make lending faster, more efficient, and even more inclusive. But the real challenge is this: can we make it truly fair? As we build this incredibly powerful new financial system, we have to make sure we're not just building a faster version of the old one. We have to make sure the future we build is a fundamentally more equitable one.
If you think about the old trading floors, it was all about humans, a lot of shouting, a lot of chaos. But today, the most important decisions are being made in microseconds, driven by something way, way faster.
So let's begin with that first big leap in automated trading, the one that really set the stage for everything that was to come.
Right, so this is what we call algorithmic trading, or you'll often hear it called algo trading. At its core, it's pretty simple. It's a computer following a very strict set of rules that a human programmed. You can think of it like a recipe. If this stock drops by 2%, then sell. It's fast, it's efficient, and it takes human emotion out of the equation. But the key thing is, the human wrote the recipe.
Exactly. And that's where you run into a problem, right? traditional algorithms are rigid. They're built on what's happened in the past. When the market does something new or unexpected, that old recipe just doesn't work anymore. The algorithm can't adapt on its own.
And this is where true artificial intelligence just completely changes the game. We're moving way beyond just executing a set of rules and into the realm of making genuinely intelligent decisions. I love this quote because it just nails the difference. See, an AI isn't just a better instruction follower. It's a system that takes control of the strategy itself. It's constantly crunching huge amounts of real-time data, learning from every single trade, and evolving its own approach on the fly.
So let's peek under the hood for a second. This isn't just one kind of AI. It's a whole toolbox of different machine learning strategies. For example, take a look at LSTM. That's a type of deep learning. It's fantastic for forecasting because it kind of has a memory of recent price moves. Then you've got something like DQN, which is reinforcement learning. The AI literally learns through trial and error, just like a human would, but millions of times faster. So, you have this incredibly powerful new intelligence. What's the actual advantage? What does it give you? Well, it really boils down to two game-changing things. Just unbelievable speed and, believe it or not, a deep understanding of human emotion.
And when we say speed, we are not talking minutes or even seconds. AI-driven trading operates in microseconds. That's a millionth of a second. It's a timescale that is just physically impossible for a human to even perceive, let alone act on.
But raw speed is only half the picture. The really mind-blowing part is its ability to read the room. It uses what's called natural language processing to scan and actually understand the mood of the market. And it does this by looking at thousands of sources in real time. News articles, SEC filings, even the chatter on Twitter and Reddit.
So think about it. The AI can instantly see a positive headline like this one,
Or a really negative one. And here's the kicker. It can predict the likely impact on a stock's price and act on that information before most of us have even finished reading the headline.
Okay, so this much power, this much autonomy, it naturally leads to a really critical question.
Yeah, exactly, because a single rogue AI could cause an immense amount of damage in a very short time. And that's why this whole new science of AI risk management has become absolutely essential for any firm that's using these systems.
So what these firms do is build a kind of fortress of safety nets around their AI. They use machine learning to try and predict risks before they happen. They make sure to diversify so no single failure can be catastrophic, and they adapt in real time. But maybe most important of all, there's always a human co-pilot watching, ready to intervene if the AI hits some turbulence.
And in practice, that human oversight is backed up by hard-coded rules the AI cannot break. These are the automated guardrails. So, for example, a drawdown limit is basically a big red emergency stop button. If the portfolio loses a certain amount of money, it just halts all trading, period. Things like stop losses prevent one bad trade from spiraling out of control.
Now, with AI becoming so powerful and so deeply woven into the fabric of the market, you can bet that global regulators are now in a race to write a whole new rulebook for this new reality.
And you can see just from this timeline, that race is really accelerating. This isn't some far-off issue. It's happening right now. The U.S. Senate is flagging risks, the CFTC is making it clear that firms are on the hook for what their AI does, and global bodies are all trying to coordinate to protect the entire market. And these are the big worries that are keeping regulators up at night. Things like herding behavior. I mean, what happens if thousands of AIs, all trained on similar data, decide to sell the same asset at the exact same microsecond? You could trigger a flash crash. And then there's the famous black box problem. How can you audit an AI's decisions if even its own creators can't fully explain its logic? It's a huge challenge.
So, when you put this all together, what does it really mean for the future of our markets?
Well, it's a huge shift. We've moved out of an era where winning was all about having the fastest physical connection to the stock exchange. Now we're in a new era where the ultimate edge goes to the smartest, the most adaptive, and frankly the safest and best governed AI. The competition is about intelligence now, not just raw speed.
Which, leaves us with this one big central question. As machines increasingly drive the market, who should really be in the driver's seat? The whole challenge ahead is to make sure that while the machines are executing the trades, it's humans who remain the architects of the market's integrity, carefully balancing all this amazing innovation with stability. Thanks for joining us for this explainer.
Was something I think we can all relate to, right?
That feeling, the absolute frustration of being stuck on hold with your bank, just waiting and waiting to ask a super simple question about your own money. You know that friction? It's a massive headache for banks. And the thing is, the answer isn't just to throw more tech at it. I mean, look at this. 2/3 of us would rather just handle things ourselves. But, and this is the big but, we only want self-service if it's actually smart. If it's clunky or stupid, forget it. We're out. And wow, when you look at the difference side by side, it is just night and day. We're going from the old way, 9 to 5 business hours, sitting on hold forever, to a new world where help is 24/7, you get a response in seconds, not minutes, and it's actually personal to you. And the key to all this? Conversational AI. It's automating up to 85% of these interactions. That's a huge number. So what's the magic here? How does your banking app seem to just get what you're saying? Let's pull back the curtain and see how it works. Okay, so the secret sauce here is something called natural language processing, or NLP for short. And this is really the key. It's what makes a computer go from just seeing a bunch of words to actually understanding what you mean, the intent behind your question. Doesn't matter if you type it or say it out loud. So let's see how this plays out. Imagine you type, move $50 from checking to savings. The AI, using NLP, immediately goes, aha, the goal here is a fund transfer. It then plucks out the key pieces of info, the amount, $50, the source, checking, and the destination, savings. Then, boom, it just does it. All of that happens in the blink of an eye. Right, but it's super important to know that not all of these digital helpers are the same, not by a long shot. There's a world of difference between a basic chatbot and something much more powerful, an intelligent virtual assistant. Think of it like this. A basic chatbot is like following a script. It's a simple Q&A machine, great for finding the answer to a straightforward question. An IVA, on the other hand, is a whole different beast. It's powered by machine learning, so it actually understands the context of your conversation. It learns as it goes, and it can handle really complex things with multiple steps. Exactly, and that's really the big takeaway here. We're shifting away from these simple tools that just answer basic questions to having actual digital teammates. These things are designed to be partners that really help you accomplish tasks. Okay, so what does this all mean for you personally? Like the next time you pull out your phone and open up that banking app? Well, it means you can do a ton of stuff instantly without ever talking to a person. Check your balance, see where you spent your money, block a lost card, pay a bill, all these routine things. And you can do it however you want, on the app, the website, heck, even on WhatsApp. A really powerful example of this in action is something called KYC, or Know Your Customer. That whole process of proving who you are when you open an account? It used to be a total pain. But now, AI just automates the whole thing. It can scan your driver's license, match it to a selfie you take, run all the background checks in real time. It's incredible. We're talking about slashing verification time and costs. All right, this isn't just some futuristic idea. It's happening right now. So let's look at a couple of real-world examples. 2 of the most successful banking AIs on the planet. First up, let's talk about Bank of America's virtual assistant, Erica. They launched this way back in 2018, so they were really ahead of the curve. And the scale of what Erica does today, it's just staggering. Get ready for this. Since it launched, Erica has handled over 3 billion customer interactions. Just let that number sink in. And what's even crazier is its 98% containment rate. Now, what that means is that for pretty much every single person who uses it, Erica finds the answer or solves the problem without ever having to pass them off to a human. It's almost perfect. And it's not just for customers. Bank of America's own employees use it too. It's actually cut the number of calls to their internal IT help desk in half, so it's a game changer inside and out. And it's not just happening in the US. Over in India, HDFC Bank's assistant, named Eva, has been a huge pioneer. It really shows how this technology can be successful anywhere in the world. Eva is everywhere, on the web, in the mobile app, and you can even talk to it through Alexa or Google Assistant. So, where are we headed? What's the next big thing? Well, the next step isn't just a step. It's a massive leap forward. The future is something called agentic AI. And you need to understand these are not just assistants anymore. They're becoming autonomous agents. This means you don't just ask it a question, you give it a goal. You could say something like,
help me optimize my savings for a down payment on a house. And the AI will actually think, create a plan, and then take multiple actions on its own to make that happen. Yeah, and as Lloyd's Banking Group says, this is not just a smarter chatbot. It's a whole new category of intelligent agent. We're talking about AIs that can manage really complex jobs, like investigating fraud or handling credit applications all by themselves. It's going to completely transform how banks operate from the inside out. And don't think this is some sci-fi dream. This is happening fast. A majority of banking executives expect this kind of agentic AI to be a core part of their business. We're talking risk management, loans, compliance, within just the next couple of years. We're talking by 2026. Which really leaves us with a fascinating question to think about, doesn't it? As these AI systems get better and better, moving beyond just answering our questions to giving us actual proactive, personalized advice, you have to wonder, will your next financial advisor even be human, or will it be an AI agent? The definition of what that means is definitely about to change forever. Let's just start with a number to set the scene. $2.5 billion. That's how much cyber attacks cost the financial industry in just 1 year. It's a huge figure, and it really drives home the kind of threats banks are up against 24/7. Okay, so let's get into the heart of the problem. You can think of a modern bank as this massive digital fortress, but the thing is, it's under constant siege, and not just from one direction. It's a battle on multiple fronts. Right, and the real challenge is that all these risks are happening at the same time. You've got your classic credit risk, people not paying back loans. Then you have market risk, where prices just swing wildly. Operational risk covers everything from human error to system meltdowns. And of course, there's the constant drumbeat of cybersecurity threats. On top of all of that, you have to follow this incredibly complex web of laws that never stops changing. And you know, the old way of handling all this, with manual checks and just looking at past data, it just can't keep up. The speed and the sheer amount of information flying around today is just too much. By the time a human team spots a problem, the damage is often already done. But what if you could change the game completely? What if you could stop playing defense and start playing offense? That's exactly where AI steps in. It's like having a new kind of sentinel that can see threats coming and act before they hit. The engine behind this whole shift is machine learning. So instead of being programmed with a strict set of if-then rules, these systems are built to learn directly from data. They find patterns, they get smarter over time, and they make decisions on their own, constantly adapting to new information. And this chart really lays out the difference, doesn't it? You can see we're moving from these rigid, manually updated systems to ones that are dynamic and actually learn. The old way was reactive and honestly created a mountain of false alarms. AI is proactive. It looks at all kinds of data, structured and unstructured. And because it understands context, it dramatically cuts down on those false positives. That means human experts can stop chasing ghosts and focus on the real threats. So, that's the tech. But how does this all translate to the real world? Like, how is AI actually being used on the front lines to fight things like fraud and money laundering? This is where it gets really interesting. Well, you can just look at a major player like JP Morgan. They aren't just dipping their toes in the water. They've woven AI into the very fabric of their security. And we're not just talking about being a little more efficient. We're talking about uncovering criminal schemes that were basically invisible before. They've got a whole suite of AI tools. Their systems are watching transactions in real time, looking for any little irregularity that might signal fraud. They use something called natural language processing, which lets computers understand human language to scan things like emails. And they even use behavioral analytics to learn what's normal for a customer, so the second something seems off, it gets flagged. Okay, so spotting a single fraudulent transaction is one thing, but money laundering is a whole different beast. It's designed to be complex, to hide in plain sight. So how does AI tackle a puzzle like that? This is a perfect example of the shift. The old rule, flag every transaction over $10,000, it just created an avalanche of false alarms that buried compliance teams. AI doesn't do that. It uses behavioral detection. It sifts through massive, complex datasets to find those very subtle patterns that criminals use. It's less about finding a needle in a haystack and more about teaching the computer what a needle even looks like. And what's really powerful is that AI isn't just about stopping crimes happening right now. It's becoming a kind of financial weather forecast, helping banks see the storm clouds gathering on the horizon. Absolutely. This is so important for the stability of the whole system. AI can look at tons of data and predict, with pretty amazing accuracy, which loans might go bad. It can run thousands of simulations. What if the economy does this or that to stress test how well a bank would hold up? It can even scan news articles and social media to get a feel for market sentiment, giving an early warning before things turn sour. So, when you boil it all down, it comes to this. Banks are moving from cleaning up a mess to preventing the mess in the first place. They can actually anticipate and prepare for risks before they happen, which is a total game changer. Okay, so AI is great at predicting risk, but what about one of the biggest, most expensive parts of banking? I'm talking about navigating that dense, ever-changing jungle of regulations. Well, AI is tackling that too. Using that same natural language processing we mentioned earlier, it essentially becomes a superhuman regulatory expert. When a massive new regulation like Basel III comes out, and we're talking thousands of pages, an AI can read it, understand it, and instantly pinpoint exactly which bank policies need to be updated. This saves an incredible amount of time and helps banks avoid huge fines. And the regulators themselves are getting on board. They aren't trying to stop this. They're creating roadmaps for how to do it right. Take the Reserve Bank of India. They've laid out what they call these 7 sutras, basically 7 core principles for deploying AI responsibly. It's all about finding that sweet spot between encouraging innovation and making sure everything is fair, safe, and accountable. Which leads to the million-dollar question, right? If these AI models are so complex that nobody, not even the people who built them, can fully explain a specific decision, how can anyone trust it? How do you audit it? And there's an answer for that. It's a whole field called explainable AI, or XAI. This is absolutely critical. XAI is all about creating tools that open up that black box. It gives you a clear audit trail that shows why the system made a certain decision, why it flagged a transaction, or why it denied a loan. Not just that it did. It's all about building transparency and maintaining trust. So let's bring this all home. The end goal here isn't just about building smarter machines. It's about creating a future where technology and human experts work hand in hand to make the entire financial system safer for all of us. And that's the key thing to remember. AI is not here to replace risk managers. It's here to supercharge them. It's a tool that handles the grunt work, the endless data sifting, which frees up the human experts to do what they do best, handle complex cases, think strategically, and apply real human judgment. And that really is the final thought to leave you with. As these AI systems get more and more sophisticated, as they go from being just a tool to something more like a digital colleague, the big question becomes about us. How do we build the rules, the ethics, and the trust to make sure this powerful partnership between humans and AI continues to protect our financial world? This for a second. Who decides if you get a loan? I mean, it seems like a simple question, right? But the answer, well, it's gotten incredibly complex. We've moved way beyond simple human judgment and into the realm of powerful, automated systems. So in the old days, your credit score was based on just a handful of things from your past. Pretty straightforward. But now, AI models are looking at thousands of data points, and they're doing it in real time. And yeah, on one hand, that shift promises to open up credit to more people than ever before. But on the other hand, it's introducing entirely new kinds of risks that we're only just beginning to understand. Okay, so how does AI actually promise to make finance, fairer? Well, it's all about looking at a much, much bigger picture than we ever could before. Right, so instead of just looking at your credit card history, AI can analyze all this other stuff. We're talking utility payments, your rental history, even mobile transactions, to get a real sense of your creditworthiness. And what this does is it helps build a financial story for people who were basically invisible to the big banks before. And get this number really shows you the impact. There was this one FinTech company in Egypt that built an AI scoring engine, and it hit a 60% loan approval rate for people who were totally unscorable by the old rules. That's a game changer.
But with every powerful new technology, there's a dark side. And when it comes to AI and finance, believe me, the stakes are incredibly high.
Here's the critical thing you have to understand. AI can take our own human biases and not just copy them, but actually make them worse. One study, for instance, found that some AI models were approving Black applicants at a rate 28% lower than white applicants. That's a huge disparity, and it points to a systemic bias that's literally baked into the data.
So why does that happen? It's pretty simple, actually. If the data you feed the AI is biased to begin with, if it reflects historical inequalities, then the AI just learns that bias. It ends up continuing these unfair practices, even though no one programmed it to discriminate on purpose. And it's not just about bias. There are some really serious security threats, too. Imagine an attacker using something called data poisoning. They could sneakily feed the AI bad information, basically teaching a bank system to ignore obvious signs of something like money laundering. That creates a massive, permanent hole in their defenses. And maybe the most unsettling part of all of this? The lack of transparency. A lot of these complex AI systems are what we call black boxes. This means if you get rejected for a loan, it's almost impossible to find out why, or to even argue against the decision. Because honestly, sometimes even the people who built the AI can't fully explain its logic.
Okay, so what are we doing about all these risks? Well, the answer is to start building some serious guardrails, new laws and much better industry practices. One of the biggest moves so far is the EU AI Act. This is a huge deal. It's the world's first comprehensive law for AI, and it sets really strict transparency rules for what it calls high-risk systems. And yes, that includes credit scoring. The deadline for full compliance is August 2026.
And you better believe they're not messing around. If you don't comply, the penalties are severe. We're talking fines that can go all the way up to 35 million euros, or even 7% of a company's global annual revenue, whichever one is bigger. That's got everyone's attention. But it's not all just about rules and penalties. The industry is stepping up and developing some really cool new techniques. There's stuff like fairness-aware machine learning to directly fight bias, and explainable AI, or XAI, which is all about creating tools that let us finally peek inside that black box. Okay, so beyond just managing all the risks, AI is also completely shaking up what it means to actually work in finance. Think about all those repetitive manual tasks. They're being automated on a massive scale. And this is freeing up finance professionals to stop doing boring reports and start focusing on much higher value work, like actually making sense of what the AI is telling them. And the scale here is just staggering. Take JP Morgan, for example. They have this platform called Coin, and it saves the company over 360,000 work hours every single year. How? By ripping through thousands of commercial credit agreements in just a few seconds. So what does this mean for careers? Well, it's creating entirely new jobs that, honestly, didn't even exist a few years ago. We're talking about roles like AI model auditors, knowledge engineers, and AI product managers. And for all of these, you need this new blend of skills. You need to know finance, and you need to be fluent in tech. So if you want to stay competitive, what do? Well, you have to start developing some AI-related skills. You've got to understand how these new tools actually work. And probably most important of all, you have to get used to constantly learning, because this field is changing faster than you can blink. All right, so where's all this really heading? We're starting to look beyond just simple automation. We're moving toward a future of what you could call autonomous finance. The next big leap is something called agentic AI. Now, try to picture this. Think of them like digital workers. They could have their own corporate logins and be able to handle complex tasks all by themselves, with a human manager just supervising their work. It's pretty wild. And that leaves us with one final and really crucial question. Look, this technology offers incredible efficiency, amazing progress, but it also forces us to stop and decide, what role do we really want humans to play in a system that is, more and more, thinking for itself?